Did you know that even the most accurate trading strategies could still fail without proper risk management? That's why in this video, we're going to be breaking down all the do's and don'ts of proper risk management in the foreign exchange market. Now, let's dive into the first topic, which is discussing the dangers of over-leveraging. You see, the foreign exchange market is super appealing to a lot of new traders because forex brokers oftentimes provide high leverage, and leverage just allows you to place very large positions in the foreign exchange market without actually having to put a lot of capital on the table. So for example, let's say that you only have $100 to invest in a forex account. Well, if you sign up with a forex broker that provides up to 100-to-1 leverage, well, your $100 account balance now multiplies up to $10,000 that you could trade in the foreign exchange market. And even though this does sound advantageous because it can multiply your profits, it could also magnify your losses as well. That's why I want to make sure to go over and discuss how to properly leverage your account in the foreign exchange market. So first, let's discuss what's a proper leverage ratio. If you're a new trader looking for small, consistent wins and you're risking only 1 to 2% of your account balance per trade, you won't need much more than a 50-to-1, maybe 100-to-1 leverage with your forex broker. But if you're looking for high risk, high reward strategies where you're risking 30 to 40% of your account balance, and I highly wouldn't recommend new traders doing this unless you sustainably yield profits over an extended period of time, then maybe you'll need 200-to-1 or 500-to-1 leverage. Now, usually regulated brokers don't provide over 100-to-1 leverage, so if you're looking for really high leverage, you'll probably have to go with an unregulated broker. So that brings us to our next point, which is how much should I risk per trade? Instead of looking at how much money you're going to risk of your account balance, look at the percentage that you're going to risk of your account balance. So let's say you have a $100 account balance and you're going to risk 2% of that account balance. Then in turn, you're going to be risking $2, but you want to make sure that you're risking a static 2% of each trade that you're placing in the markets. And I highly recommend, if you're looking for sustainable, consistent gains, to risk anywhere from 1 to 2% of your account balance. And trust me, I get it. I know there's a temptation to want to over leverage your account balance to try to make so much money in one trade. Trust me, this is a long game, not a short game. You want to make sure that you have small, consistent wins and not just getting rich off of one trade. And like I said earlier, if you have experience with trading and you have sustainably yielded profits over an extended period of time, maybe you want to try to multiply or compound your account balance. You could risk anywhere from 20 to 30, maybe 40%, but you have to understand that this comes at a very high risk, high reward price. Now let's discuss a very important concept within risk management. That's utilizing stop losses and hedge orders. So a stop loss is what I like to refer as insurance for traders. It's basically a predetermined point on the chart where you'll automatically get closed out of the trade at a loss because you don't want to endure any more losses because the market has moved against your position. The reason why stop losses are so advantageous is because it allows you to mentally prepare your maximum loss per trade. A common statement that I just want to make sure is stressed: do not move your stop loss based on emotion. We've all been there where we're a new trader and emotions get the best of us and price is going into drawdown and we end up removing the stop loss or moving it farther down. Make sure to not move your stop loss based on emotion. Now, another risk management technique that I want to discuss is called hedging. Hedging is very similar to stop losses, but instead of automatically exiting that position, you would place the opposite position that you initially placed. So let's say you placed a buy order around a significant support zone, and instead of placing a stop loss, you would place a sell order whenever price comes to that significant price point, and it would be a sell stop or it would be a buy stop if it was the other way around. So using the previous example of how we could logically implement hedging into our trading system, let's say that we placed a buy order off of the support zone, but instead of bouncing, it ended up violating the zone and just kept going towards the downside, activating our hedge order. What we would logically do is wait for price to go to the next support zone, and then we would exit that sell order and wait to see if price could bounce back towards the upside to try and exit that first buy order around break even. So you're profiting off of that sell order while also being able to manage that first buy order near break even. So instead of getting stopped out of that trade, you're able to make more informed trading decisions based on what's happening on the chart. And something that I must stress is if you are not utilizing a stop loss or hedge order on every single trade that you place in the markets, you are risking way too much and you're probably not going to find sustainable profits. It is super important to preserve your account balance, and one of the best ways to do that is by utilizing a stop loss or hedge order, so make sure you do so. And just a little advice for stop losses and hedge orders, I highly recommend placing them above or below invalidation zones. Invalidation zones are basically a point on the chart where if you are entering a trade, you no longer want to be in that trade any longer if price hits that certain point. So if I'm placing a buy off of a support zone and we end up cracking that support zone, I probably don't want to be in that trade any longer. So that's ideally where you want to place your hedge orders or stop losses. Now, the next important topic, which is understanding risk to reward ratio. The concept of risk to reward ratio is very simple, but very crucial to a trader's profitability. This ratio compares how much you're going to risk versus how much you're going to potentially gain on each trade you place. So let's say I was going to risk 1% of my account balance, but it was to gain 2% if I hit take profit. This would be a 1 to 2 risk to reward ratio because I'm risking 1% to potentially get 2%. Now, it's important to note that the higher your risk to reward ratio is, the lower your winning percentage is going to be because it's less and less likely that you're going to hit take profit. So that's good to know when you're trading the markets. Considering we've discussed the main topics of risk management in the foreign exchange market, now I want to discuss a risk management tool that will absolutely save your life. It's called a position size calculator, and this is completely free if you look it up on the internet. I use my FX book, but there's a bunch of different apps like Stinu and other free platforms that will quickly calculate it for you. This calculator properly leverages your account balance based on your stop loss in pips, your account balance, the market that you're trading, and how much you're willing to risk per trade. If you are not utilizing a position size calculator before every single trade that you place in the markets, you are over leveraging or under leveraging your account. So it's super important that you're utilizing this calculator to make sure that you're properly leveraging for sustainable growth. So now that you understand the basics of risk management, you are much better prepared to actually take on the foreign exchange market. Remember, every single trade that you place in these markets carry risk. But with a proper risk management technique and practice, it will act as a shield against the unpredictable nature of the markets. This is Mike from CapitalHillFX. If you got any insights or value from this video, if you could just like and subscribe, it would mean the world to me. Love you all. I'll see you soon. Cheers.